Hi, everyone. Thanks for joining us. My name is Rob Anton, president and partner at Next Edge Capital. With us today is Erica Axani, chief risk officer and head of credit at Next Edge Capital, and Tammy Kemp, chief credit officer of the Garrington Group, which is the primary credit advisor to the Next Edge Private Debt Fund. Focus today, we're going to cover off a lot of topics. Do a brief review on portfolio metrics of the fund. We're going to talk a little bit about kind of philosophy and some key metrics on how we lend to the different various lending buckets that we provide capital towards. I'm going to talk a little bit about origination, talk about the audit process that we went through in 2021 and 2022, as well as our credit facilities. We're going to speak about expected portfolio yields for 2023. And we're going to finish off with a discussion on just, portfolio health, any issues within the portfolio, risk management, things like that. And then we'll allow you the chance for question and answer. If you do have any questions, just enter them into the Q&A function at either the top or bottom of your screen. So we'll get going here. When we started this fund, so the fund is, at the end of May of this year, we'll hit its 8-year track record. When we launched this fund, the primary, we had a number of goals. One was to provide an attractive and consistent, rate of return to our investors. I think we've checked those boxes thus far, since inception. Almost 8 years ago, we've compounded at 8.24% on our most popular F1 class. Regarding consistent returns, we've done this with an annualized standard deviation of 0.52, maybe not a real fair number to utilize in the sense that they're privately negotiated loans and don't trade. That being said, it is a reflection of the client experience. Number two, preservation of capital, very key goal. One of our mottos of the team is win by not losing. I think we've checked that mark. We've had one down month over the last almost 8 years. And, something that we probably don't talk about enough is that, and another primary goal is to be a great diversifier to, other stocks, bonds, and other alternatives within your portfolio. And when you look at the correlation to, the TSX, S&P 500, and most major bond indices, in that last 7 3/4 years, the correlation numbers typically come in less than 0.1, which means that essentially this fund has delivered those type of returns with that consistency, as well as being a superb diversifier within a portfolio context. What our fund does is, it deploys capital to businesses throughout North America. All these financing facilities are privately negotiated between us and the end debtors. And, we're primarily first lien lenders, and I'll talk about that in 1 second. And the one kind of theme throughout what we do is that these facilities are collateral-backed, and we'll talk about that in a moment. Our portfolio is fairly diverse. Currently in the portfolio, we break down the kind of collateral-backed buckets into a number of different areas. We currently have about 55 different loans in the portfolio within our asset-based lending, asset-based lender finance, and specialty finance type categories. We have just under 100 factoring transactions, and then a few more lender finance facilities to a franchise division of Garrington Group called Liquid Capital, which are also lender finance type transactions. So fairly diversified, portfolio through a lot of different funding solutions. Fairly evenly broken down between Canada and US historically. I would say that going forward, we might see a slight bias towards a little bit more on the US side than in Canada. But thus far in the past almost 8 years, it's been fairly evenly split. We have a fairly broad exposure. So a lot of people see us as a Canadian player or, a regional player in the US. We're quite broad. We currently have clients in over 33 different states and 6 different provinces in Canada. And that's been fairly consistent for quite a number of years now. And, as I mentioned before, we're primarily primarily, first lien lenders. It's 87% of the portfolio on a dollar weighted basis, is first lien. It's hard pressed to typically get us to go into the second lien, but if in rare circumstances where we like the deal, or we come in with a mindset where we might take out the first, if push comes to shove, we might get comfortable getting into that position. But you can see us as primarily a first lien lender. With regards to the types of loans we put on, the one thing I would say is that, we are on the shorter end of the lending spectrum. So, a typical term for us is a year, maybe out 2 years, on some facilities. That being said, we have just under half of our portfolio is floating rate in nature. We have made a conscious effort over the last 2 to probably 3 years to put out most of our loans on a floating rate basis. That said, we do have some legacy clients, that we continue to roll with a fixed rate. In some loans that come in that are expected to be shorter date, sometimes we do it as well. That being said, a significant portion of the portfolio does turn within a year. So it's not like on the fixed side, we're locked in to those rates for an extended period of time or anything. On a loan to value ratio basis, it really depends on what the asset is and what the company is. But when you work it out on a dollar weighted basis, within the portfolio, current LTV sits around 56%. I'm the first one to caution investors about the V in LTV. There's a lot of different ways of calculating it. And there's in our calculation, there's quite a bit of things that are not included, what we consider, say, boot collateral, which don't go into our calculation, but could be value within the company that we would still have a lien against, those sort of things. But for another discussion. With regards to, our duration of loans, well, like I mentioned, we are on the shorter end of the lending spectrum, currently on a dollar weighted basis. The term to maturity is around 9 months currently. With that, we're going to start off and just talk briefly about some of the lending buckets that we gain exposure to, and kind of the philosophy and mindset towards, one, how we put out capital, what we look for in end debtors, and how we protect our capital. So I'll pass this over to Erica and Tammy to kind of give some of their viewpoints on the various different buckets that we lend to.
Thanks, Rob. Maybe I'll start on the factoring and receivables based financing. Obviously, that's very close to cash on the stack. Essentially, what we're looking for in a factoring transaction is a client that's generally not bankable, but creates a superior good or service and sells that good or service to a creditworthy counterparty. And that creditworthy counterparty, we do quite a bit of work on establishing their creditworthiness. We also credit insure those positions because, of course, when we purchase that particular invoice, we own that invoice, and we are expecting to be paid directly by the Canadian Tires, the Walmarts, the CNRLs, Enbridge. Those sort of debtors would be the counterparties that would be paying us directly for that good or service. We go so far as to notify those counterparties and let them know that we now own that receivable and expect to be paid. And we actually go even further and contact them and speak with them directly to make sure that they've received the good or service and are satisfied with it. So it's quite a bit of work that goes into making sure we're going to be repaid, but the duration of those transactions are generally sort of in that 30 to 90 days, where that receivable is turned and replaced with a new receivable and turned and replaced. So it's a nice rinse and repeat type of business for us.
And the average client, Tammy, I know the receivables turn over quite handedly, but our average client might be in that, 2 to 3 year range, possibly.
It's a very sticky relationship, right? I mean, it fills a need. generally hand to mouth. They generally prefer the flexibility of being able to factor or not factor. So send invoices in, get financing, not get financing. And, also helping from the perspective of regulating some cash flow for them. And also just, we're there when they grow, when they get that new contract in, they can turn that into cash very quickly. They know that we'll go and do the credit work on the counterparty. They know when they deliver that good or service that they're going to get paid for it, because we've already done that sort of in-house, normally what would be an in-house credit work for our clients. So it's value add. So it's a pretty sticky type of business. And yeah, 2 or 3 years for sure.
Tammy, if I could just follow on a little bit, because Rob mentioned it before when he was talking about the loan to values. In an instance where you're factoring, predominantly we have a senior lien on the company in its entirety while we're just purchasing receivables, rinse and repeating that. Let's say a client is a widget manufacturer, but they have, a significant amount of manufacturing equipment. They have an inventory of widgets, which we will have security on while we're just touching the receivables and financing or purchasing those. We do tend to have blanket liens on the company and all of their other assets as well. So that sort of explains what Rob was alluding to before regarding the loan to values. We would not consider those in our loan to value, but it does exist as part of our security package.
Yeah, great point.
Absolutely. I think great segue into the asset-based lending part of our verticals. And again, that generally leads with the receivable so financing receivables, inventory, equipment, and potentially some real estate, more particularly owner occupied, as an add-on to a particular financing facility. And I think, Erica, you're going to probably hit on that just a little bit as well. But the asset-based lending facilities, they can operate a little bit like a factoring facility. So we can actually own the receivable, which allows us to credit insure our position when we're actually lending essentially against those receivables. That is, we do a lot of work at the front end. Erica and her team spends a lot of time understanding the deal, understanding how our money is going to change, or what impact our money or our financing facility will have on that business. And also sets the stage from a monitoring perspective to better understand how we expect that collateral to perform, and then setting up from an operational perspective, KPIs, key performance indicators, telling us how we expected the collateral to act, that we can test again against the receivables and inventory as it turns on a weekly basis. So really looking at the collateral performance as clients are drawing down on those facilities. Similar to the factoring side of the business, we actually receive the cash. So we have what's called cash dominion. So when the counterparties are paying on those receivables, all of that cash is going to a protected concentration account that's for our benefit only. So that's a great way to ensure that the cash is not leaking out of the business. We get updated information, like I said, on a weekly basis, so we can judge and make decisions about how much funding we might do. And on part of, again, what Erica and her team does in understanding the business, on an upfront basis, doing appraisals on inventory, appraisals on machinery and equipment, and appraisals on real estate, from third-party knowledgeable people that we work with on an ongoing basis. So specialists in their field who understand the value of the things that they're appraising for us. And also an independent third-party field examiner who goes in and really takes a look under the hood at that business, understanding the collateral, understanding the structure of the business, really understanding what we should be looking for from a performance perspective that we do at the front end, and that sort of look through continues throughout the life of the loan. So we're never a set it and forget it type of lender. We are always going back reappraising that equipment, reappraising that inventory to make sure that we're on top of what that collateral would bring us on an ongoing basis. So what our recovery expectations should be, and ongoing field exams as well as part of what we do to monitor and measure, again, down to collateral performance and understanding the transaction and the client.
I have nothing to add to that, so I can move on to lender finance, which is an interesting vertical. So I mean, it is what it is. It's where we lend to other lenders, which I find a really a great vertical that we have. It's we treat it a lot like we do our asset-based lending. It's all about collateral, but in this case, it's a portfolio of loans of some type. So we have, if we have a client who's another factoring and ABL shop, we have a few of those clients. Obviously, it's easy for us to review and understand that type of business. Where it's a different type of loan, we're still looking at lenders who have underlying security on some kind of an asset in that portfolio. So we've got an underlying asset, a lender in between, and then us on the top. So the general concept is there's that nice buffer. So as Tammy was talking about with ABL, we're applying advance rates to appraised values and that giving ourselves a buffer between our loan and the collateral. Well, in these instances, our client has that buffer between their loan and the collateral, and then we have an advance rate we apply to that. So our LTVs here tend to be a lot lower because we have that extra buffer because we're only advancing a certain percentage. And part of that is because to be a lender finance client of ours, it's very important that we, one, understand the loans that they're providing, understand their portfolio, the credit parameters or the credit policy that they've set up. It needs to make sense to us. It may not be loans that we provide that their portfolio is based on, but we need to understand their lending metrics. So similar to how Tammy and I are talking today, we would have a conversation with a potential client in the same way. Explain to me what you look at, how you value it. And then naturally we send in third parties to go in and examine. We examine ourselves, really reviewing their credit policies, their default histories, their write-off history, what they expect in terms of delinquent loans and those kinds of things. They also have to be a little bit of a better credit quality because not only do they have to be able to provide that buffer between our advance rate and their loans, but we like to see them have a lot of skin in the game. So typically a lender finance client will have a stronger balance sheet. We don't covenant a lot because, as Tammy said, we're very collateral centric. But for sure, when it comes to lending to another lender, there always has to be a tangible net worth covenant, not only to cover that buffer between our advance rate and their loans, but to provide that extra skin in the game, or as some people might call haircut capital. So they have to be a little bit of a better quality. They can't be a startup. They can't have losses that are unexplained. Generally, they're break even to growth mode to profitable. Because we do tend to be quite picky with our lender finance clients because they have to be a little bit of a better caliber. And these clients might be too small for a conventional bank. A lot of banks that tend to lend to other lenders tend to look more in the 50, 60, 70 million dollars as being on the small end. So they're sometimes too small, or they're in growth mode, or we can provide better advance rates. The fact that we can understand their business better, certainly when we're lending to other factoring and ABL shops, we certainly understand their business. We can go in and we may not necessarily have to have the exact same credit policies or the exact same products offered, but we need to understand the products they offer and understand the history. So we run a lot of static pool analysis and things like that to really dig into those portfolios. Same as asset-based lending, we have cash dominion. So all of the collections that they're collecting directly from their clients on revolving bases or on direct assignments from factored receivables, that flows through our bank account. So we have cash dominion control over that as well. As it comes to specialty lending, anyone who's familiar with banking, please don't confuse specialty lending with specialty loans that you would have if you're in special loans at a bank. That is not what this is. This is anything that doesn't quite fit the other buckets. I can always find, you can find something about these type of opportunities that you could fit in either, let's say, lender finance or asset-based lending. But generally, a specialty loan in our portfolio would be something that's a little bit out of the norm. Always collateral backed, but perhaps this would be recurring revenue from long-term contracts. So a company that has contracts set with their clients that pay out over 10 years, and they've got a great track record, and they've got locked in contracts that can't be canceled, and you can consistently see those cash flows that come in from the company. You can run net present value calculations on that. Again, we apply advance rates to that, always putting a buffer in. But this is sort of the catch-all category for something that doesn't quite fit into the others, but is collateral backed, can be wrapped up, first lien secured, and we can always find a way out. I mean, the main event in all of these categories is what happens if something goes wrong? How do we get out, right? So specialty loans where you're looking at, it's a cash flow loan or recurring contract revenues that are coming in. The closest to cash you can get, the easiest way you can get your money back on the loan, the better. And that's what we underwrite to. So if it's recurring contracts, I can give a real-time example, just because this one is a little bit of a stranger bucket. We looked at an opportunity where a company serviced elevator, was an elevator servicer, and they had recurring contracts with their clients where they would go in on a regular basis and service elevators. So those clients would pay on that contract every month for those services. But in looking at it, we didn't view it as an opportunity for us because we have to look at it from a wind down perspective and say, how would we get out? Well, we'd have to collect on those contracts, but you would continue to have to employ people. You would continue to have to service those elevators, right? Therefore, continuing to run the business and incurring expenses throughout the life of trying to wind down, making that wind down more difficult. If the contracts are different, of a different nature, where they're, one client we have that straddles specialty finance, lender finance, is they have contracts with individuals for hot water heaters, HVAC systems in their homes. And it's just, their loans are set it and forget it for their clients. They've installed the piece and they get paid to rent that piece for the next 10 years. That you can easily sit back, have someone at a desk with a light bulb, clicking and collecting payments each month. That's sort of the different, really rudimentary way to sort of explain how we kind of view specialty finance loans.
Thanks, Erica.
No problem.
So we're going to move to discuss a little bit of origination. Erica, you're fairly embedded with a lot of the originators. Maybe just to give a quick overview of the team, who we all get deals from within our organizations. Garrington, NextEdge. The types of people we work with and get the origination opportunities from, and maybe just talk a little bit about the pipeline. We have an example of what happened in 2022 with regards to deals funded and opportunity source. So maybe in like 3 to 5 minutes, kind of tackle that area.
Sure.
With the underlying philosophy, everyone, that we truly believe we're only as good as the deals we see. So it's a very important part of the business, and we definitely probably weight it a little bit more heavily than some of our competitors. So go ahead.
Sure. So as you can see there, we have 7 business development professionals, or BDOs, as I may use the term as we go through, and 20 franchise professionals. Those are the ones who own a factoring franchise that also operate. They bring in factoring transactions as well as the off ABL or lender finance transaction. But our 7 professionals, they sit on both sides of the border, so it's across North America. We're very well spread throughout North America. Of the business development professionals, one of the important things to note is a lot of these are previous credit people. So the first line of defense is, they go out, they're speaking to investment bankers, commercial bankers, advisors. They've got their network of professionals that they work with who are our referral sources, who refer these opportunities to them. They're the first line of defense in reviewing opportunities before they even cross our desks or my team's desk, in order to really vet an opportunity and see if it's for us. So we're working with people who are professional minded, credit minded, who kind of get that box that we play in. So we've already, even before we get to the 629 opportunities sourced, that's already been whittled down by these BDOs having that credit experience and being able to really only funnel through to us stuff that might have legs, as we say. So as you can see here, it's a perfect example of having all of those business professionals bringing these opportunities in. The more you have the luxury of choice, right? And that's the most important for us, is the luxury of choice, because the more opportunities that come in, the more we can pick out or cherry pick those that really fit our credit box, those that really work for us. We are not the type of entity that says, bring them all in because then I can book more deals. It's bring them all in. I'm still probably going to book the amount of deals that we're going to book, but I can really choose now and really focus on those that make the most sense to us. So the more opportunities that come in, the better for us, just by having the luxury of choice. Consequently, in lull periods, if month over month, you'll see differences. December, January is slow. It's holidays, right? But seeing less opportunities doesn't make us open our credit box. Well, we're seeing less, so let's broaden, let's go to a little bit more dicey credits or step out of the box a little more than usual. We tend to keep our credit standards no matter what that flow is. We just get more opportunities to really pick the best ones the more that we see. So really, this is a typical scenario that I would think that we could expect in any given year: 629 opportunities sourced and 45 closed, right? I always tell people, you have to have a pipeline of 40 deals to close maybe 3 or 4. And that's pretty much standard, because you're really looking at a lot. Something that we say frequently is you got to kiss a lot of frogs in order to meet to get the prince or princess. So we do that, and having all of these credit-minded individuals sourcing these opportunities for us, pre-vetting them, bringing them in, really allows us to hone in on those that make sense to us. Again, not sacrificing our credit quality based on what the flow is on any given month.
Yeah, and I would just add, there's been a lot of time and effort, within Garrington and with some help from Next Edge to, really ramp up the efforts on the origination side over the last 2-3 years. Mm-hmm. I believe our database of potential referral sources that we drip on is in excess of 15,000 now throughout North America. And, we actually slowed down our origination, footprint over the last 6 months, just because we could use more capital to deploy. But, we could definitely double our book size quite handedly with the team in place and the origination opportunities that we know we can see. So, but it's important to talk about anyways. With regards to deals closed last year, we closed 9 loan transactions and 36 factoring deals. That amounted to about $140 million of capital. Last year, I guess our average AUM was maybe around 380. So that represents about 38% of the portfolio or such was replenished with new transactions last year. With that, we're going to start more just kind of discussing various different topics, some that are somewhat topical. Before I get to some of the juicy stuff, Tammy, I thought it'd be, because, so much work is put into this, but we get very little credit for it. So I'd like to talk about it with a bigger audience. And that is the audit process. Obviously over the last few years within Canada, the auditors have maybe lost a little bit of respect from the general investor community with one of our peers in Canada. That said, Ernst & Young, audits our fund. Maybe if you could discuss a little bit the extent to which, our audit process was in 2021 and 2022, which I guess should be complete within a day or so.
Gosh, I hope so. I'm exhausted.
I'm hearing it should be, but
I think I've spoken about this over the last couple of years in particular. I've been in this space for 25 plus years, and I had personally never experienced an audit, sort of financial audit process, anything remotely resembling what we went through in 2021. And again, surprising to me, what we're being put through again in 2022. The level of review, the level of materiality has come down significantly. So we are, providing information to auditors, and historically would have been reserved more for auditors that are coming in from a banking perspective as opposed to a financial audit perspective. And by that, I mean, the auditors are going in so far as to verify not only do we actually have a credit agreement, they want to see the executed credit agreements, they want to see the evidence that we've actually registered the security that we said we have. And further, they're actually looking to see whether all of our distinct positions are really owned by various entities or different people, so that we don't have some unknown or undisclosed concentrations by having sort of one person own five or six entities across the portfolio. We just don't, I guess from my perspective, is we don't do business like that. So it always seems a little bit surprising that we're being put through the in-depth review that we have been, again, both last year and again this year. We didn't really see a let up from a audit perspective. The materiality levels were the same. The oversight was the same. We tread in some instances a lot of the same questions and rehashed a lot of the same materials. But having said that, for me, I almost put it back to being a performance review, right? If we're doing the things that we should be doing in the ways that we say that we're doing them all the time, it's never an issue to produce that information when we're asked for it. But gosh, it seems like a really long process that starts in January and ends in March. And it covers a lot of ground. So it's pretty intense.
Yeah, for sure. And I guess in addition to our annual audit with Ernst & Young, Tammy, which has been definitely probably 2 to 3 times as onerous as prior years, we also have credit facilities with 2 major banks, so CIBC and BMO, both led under their U.S. divisions, have 47.5 and 50 million U.S. credit facilities to us. They also perform audits on us. So maybe just discuss that for like 20 or 30 seconds, what that encompasses as well.
Absolutely. So CIBC's in twice a year and BMO's in 1 time a year. And we try and sort of spread those out because it's not the same group that does both. So it's not like you can combine them. It's individual examiners that are coming in 3 times a year to take a look at our portfolio. And it's funny to be on the other side of it because it's not particularly dissimilar to what we put our clients through when we send in field examiners or field auditors to look at our clients' business. And they're looking at our credit policies, whether we're adhering to our credit policies, whether we're doing the things that we say that we're doing, right through to looking through to our clients, evidencing that the collateral is there, evidencing that we're appraising the collateral with parties that are approved on our credit policy, and that we're lending the values that we should be lending. So those are, it's in depth. It generally starts with a list of about 70 items that we prepare in advance of their visit and deliver to a data room. And the actual on-site work is generally over a week to 10 days, and there's work that continues for about a week afterwards, culminating in a report that goes to our bankers and any sort of findings that come back to us, so we can talk about how we might want to deal with those. I can say with some pride that there's never been a material finding in any of the audits. It's usually limited to this report was asked for, we didn't provide it, it was missed or misunderstood, and it gets provided subsequently. So rather proud of the team and the effort that goes into to delivering meaningful in these sort of audits and reviews.
Yeah, I'm sure once it's complete, you're all due for a vacation.
Fair.
Yeah, so nothing obviously replaces you doing your own due diligence, but you know, there are a lot of sets of eyes on us, which ensuring that, you know, we're adhering to our policies, procedures, you know, the way we're telling people we do business, things like that. So doesn't hurt anyways. Next, we'll jump on to the next topic here. You know, one with regards to portfolio yield expectations. You know, in the last year in Canada and the US where we do business, you know, the Fed bank rate has increased significantly, you know, by about 4%, you know, throughout the course of last year. You know, one question that comes from clients is, you know, can we expect 4% higher return? You know, and the simple answer is definitely no. But, you know, I think there's a few topics of discussion here, which can kind of give people at least, you know, somewhat of an answer. You know, first is, you know, last year we made a conscious effort to renew a lot of existing client loans, ones that have been on the books, you know, sometimes for a number of years. Tammy, maybe you're best to talk a little bit about those, since you dealt with a lot of those existing clients that we did renew, and talk about kind of the philosophy on why we like that as opposed to putting a new loan on the books. And we actually had to take a, you know, a yield haircut on some of them as well. So maybe just briefly talk about that to start.
Sure. Well, you know, I'm a big proponent of retaining the client where it makes sense and where it's appropriate for us. You know, as Erica described, the number of BDOs and the work that they do to bring a client in, talk about, you know, taking 629 frogs and turning them into 45 new 45 new transactions, right? I mean, that's a lot of work. So there's a lot of acquisition costs that goes into getting those clients and bringing them on the books. If you have a good client that's doing the things that they said they would do, where they're appreciative of the business and flexibility and opportunities that we allow them to take on, then I think it's worthwhile to try and retain that client. Often, I mean, you know, we talk about, you know, when it's renewal time, it's not like we automatically assume that we'll just keep the business and roll on. Our clients are smart. They're going out to, whether they're doing it through a broker or whether they're doing it on their own, they're going out to the market and seeing what they can get, right? Whether that's service, whether it's size of facility, whether it's structure, or whether it's cost. And we bring they bring that back to us. And we're always seeking to win the business in the places where we think it's appropriate. And sometimes that means you need to give a little bit on rate to retain the business, because you understand the client, you're happy with the collateral, they're performing in the way that you want them to. So it's worthwhile. And we've, frankly, to me, that's a win. And over the past couple of years, we've been able to do that with some pretty significant clients, where I think it's made good sense from a risk and reward perspective.
Yeah, great. Erica, since you work a lot with the team on all the new loan opportunities, you know, I mentioned that the, you know, bank rates have gone up by 4%. You know, for new loan opportunity, you know, we talked about existing clients that, you know, it's kind of the devil, you know, it's a comfort there, and, you know, companies we know extremely well. But what about new companies? You know, a typical deal that we might have put out at 11% interest rate 12 or 18 months ago, you know, can we we're just not able to put that out at 15% at this point, correct?
Yeah, correct. Competition is a very big factor right now when it comes to establishing rates, right? Which again plays into that luxury of choice, right? The more you're looking at, then you can kind of find the opportunities where you can get the yield that you need to get. You don't have to cut your rate so much that you're either breaking even or booking a loan at a loss. So you're able to sort of weed through to find the ones where you can obtain an appropriate yield for the risk. There's so many factors. What's the risk factor of this deal? What can I win it at? What are my competitors coming in at? There's so much at play here. So, right now we're in the, I would say 13 to 14 space is what we're looking at, because what you would previously see in a 12% opportunity, you're just not seeing, right? And again, we're not going to sacrifice our credit quality, our credit box, our credit policies in order to book something. We're going to find the ones that we want to book and issue loans to, and we're going to stick firm to what we think our yield needs to be. Every now and then we might cut yield if there's a strategic opportunity, specifically when we're looking at lender finance transactions, right? When you have another factoring company as your client, there is an immediate synergy with them because they're generally smaller than we are. So they're going to source opportunities that are too large for them. And that will create more instances of more looks, more opportunities for us. So it just adds another facet to look at. So every opportunity that we're looking at, we're pricing according to what we see. But really right now, pricing is definitely a factor when it comes to competition, for sure. For sure.
So a little bit of a bias to increase, but definitely not 400 beeps. And I know that there's been a mindset within the collective teams of with what's been going on in the marketplace over the past year to err on the side of caution as well. So that has restricted it. The last I ran portfolio gross yield recently, we are a little bit higher than we were about 14-15 months ago, but not materially higher. My guess would be, and based on some new deals that I've seen coming through the system, Erica, I know we the three of us talked about some new term sheets that we have out that are at rates definitely higher than the gross yield of our portfolio by a fair amount. So I think as things work themselves through the system, I think we might get a bias towards a little bit higher within the portfolio, but definitely don't expect a 200 or 400 basis point increase from our gross yields in the portfolio. We're definitely not seeing that, nor are we, but it's also a bias that we're taking on staying with existing clients as well as for security and erring on the side of caution. Last topic, I know we've hit a fair bit already, but last topic is with regards to risk management and portfolio health. Tammy, why don't we start this off? If you can give me maybe a few minute overview on the whole risk management process, what the team does, who's involved, because, a lot of people, when you first talk about private lending, everyone thinks it's all about underwriting. And, I would say that, in my mind anyways, it's a third origination, a third underwriting, and a third monitoring afterwards. So maybe just talk a little bit about what the team does, and then we'll kind of get into portfolio health, what you're seeing with the existing book, stuff like that.
Sure, absolutely. Underwriting is obviously key. You've got to get it right, structured right at the beginning, making the right decisions up front. And then handing it over to the operations team. And as I said before, we're not a set it and forget it lender. And that means that we're spending a lot of time on a weekly basis looking at collateral performance. So it starts with our collateral analysts who are ingesting the information from our clients, looking at the receivable performance, reviewing collections, looking at the new sales, how does that fit into what the client expected to be doing during this period, managing sort of that budget to actual expectations and understanding where they are from that perspective. So the collateral analyst does a lot of work utilizing our systems and processes and our portfolio software, and make sure that what we're seeing from a performance perspective makes sense. That information rolls up to the relationship manager, working side by side with the collateral analyst, reviewing that information, having the conversations with the clients. Those conversations happen on an ongoing basis. We're asking questions, want to make sure that we understand what's been challenging in their business, what's working well in their business. Erica, I know you said it in the past, and I've heard you sort of make the comment, and it's a great one. We could probably put together our client's balance sheet and income statement before they could at the end of the month, based on seeing all of the information we see on a week over week basis, right? We know what their gross margins are. We know what their sales are. All of those pieces we put together on a weekly basis. And it comes back to who we are, which is very much collateral focused, understanding what we expect to see from our client. But even more importantly, I think it comes back to that relationship perspective. You have to be able to have the hard conversations, the tough conversations with clients. You have to feel comfortable asking questions that are important to understand, and also being really good at listening and hearing what's important to our clients, and hearing when there's challenges in the business, and thinking about ways that we may be able to work together to work out on an issue or a problem. And that comes back to win by not losing, understanding what's going on in the business, marking it against what we expect to happen, and giving ourselves the runway if we have to make tough decisions or we have to move or pivot around challenges, being able to be creative and do that. And the earlier you can identify an issue or a challenge, the more time that you have to be able to deal with it appropriately, and really manage any sort of risk that might be prevalent or at issue at the time.
If I can, I'll just add on a little, as Tammy said, all of that gets set up from underwriting. So just to drive home the point, we are very collateral focused, but it's not about the collateral. Anyone who would say, well, you have this piece of equipment, it's worth $10 million, we're only looking for $3 million against it. Anyone would say, hey, that makes sense. But what's really important for us is the story, as Tammy's talking about the relationship, because not only is that important throughout the life of the client, but we've got to set that up from day one in understanding, because we are not loan to own. We do not take the view that, well, I can just liquidate it and get my money back. We don't want to. It takes time, effort, money, brain damage. It exhausts everyone having to liquidate anything. So we don't want to end up there. We want to know we'll be safe if we do, or relatively in a good position if we do, but we don't want to be there. So something I often say is, when I speak to a potential new client, the first thing out of my mouth when I talk to them before I even get to the collateral is, tell me where you've been, tell me where you are, and tell me where you're going. And it has to make sense. What happened in the past? What are you dealing with today? How can I help that? And where are you going to go with that? And does where you're going to go make sense? Are you going to have a viable business in 6 months? Or, as we say, do they need to go for a car wash and wax, right? Does the company need, a restructuring or to file or make a proposal? We want to get into an opportunity where they may not necessarily be in the best situation today, but let's understand it. Let's see that where they're going to go with it makes sense. And then, as Tammy said, applying that logic throughout the life of the client with us. Are they meeting those expectations? Sometimes they don't. Right? But then it's readjust, reconfigure. How do we approach this now? You didn't hit your targets, but how are we going to tackle that now? What are your next plans? Consistent understanding from day one throughout the life. So I just wanted to drive that point really home.
No, good point. Before we segue into kind of some of the portfolio health, I think that, one question that even came up on the screen now is just with regards to deferred or PIK loans. Maybe, just explain our philosophy towards that as a start, and then we'll kind of get into some exact metrics here. But either of you want to tackle that as far as, in general, our philosophy towards having loans put out that don't pay us an interest in the first place?
Sure.
Can I take that?
Sure, I can. Simply put, I think it's critical, and it really speaks to the manner in which we think about somebody who is worthy of receiving a loan from us, right? It comes back to that sort of level of thought, and we expect that our borrowers cash pay the interest and principal pursuant to how we set the loan up. Most importantly, we think that we have to pay interest. We pay interest to our investors. We pay interest to our bank lenders, and in order to be able to do that, our clients need to pay us. And I think that is a premise that's integral to the lending relationship, and that's so to me, cash paying is an element that I think makes us has us standing out from the crowd a little bit, because I think that's a philosophy we've always had, and we haven't moved off that philosophy in our portfolio.
Great. Moving on to kind of portfolio health. Currently, we have a couple of, one loan and one kind of factoring position that are in technical default. They represent less than 0.5% of the portfolio as far as value. Some issues can and will happen. They've happened, in the past, and they'll continue to happen in the future. Outside of those two kind of technical defaulted loans, of which, one has been marked down already a fair bit as far as net carrying value. And we, as part of our valuation policy, we do adjust those, monthly when needed. But there's one other position, Tammy, where, there's been some concessions made whereby they're partial pay. Maybe give us a 30-second kind of overview on that situation. With the kind of, concept, I think we want to get everyone to understand that just because sometimes we have to work with a client a little bit, it doesn't necessarily mean that we're going to lose money at all. So that one is maybe a good example of one where, we've given them a little bit of concessions as far as, allowing them to partial pay, but, we're not worried about it. So maybe give a little background on that and what we've agreed to do with that client.
Sure. So it's sort of circling back to that PIK question, right? Does it ever happen that you have to give some allowance or allow for a little bit of time for somebody to effectuate a turnaround? And yes, of course, right? I mean, that happens. Nobody has a crystal ball. You can't have perfection all the time. In our portfolio currently, there is one loan that partially PIKs. So it has a partial cash pay component, and the balance of the accrued interest PIKs to the capital. So it just adds to the loan every month. But I think, I said it's pretty few and far between, but it does occur. And similarly, when we talk about, measuring our clients to what we think or what they've told us they're anticipating from a performance perspective, we may set certain benchmarks or covenants based on what we see when Erica and her team are actually working on that deal, setting sort of those, what I call early warning triggers. We call them covenants as well. And those are really designed not to be sort of the endpoint at which, if you pass it, there is a risk of us losing principal or not recovering on the asset value. Though that's not the purpose. It's a financial benchmark where we might say, this is what we've expected from you. And if you don't achieve that, then we need to be looking at what's going on in your business. It's an opportunity for a discussion. And we may have to reset a covenant at that point that more accurately reflects what's going on in the business in the moment. But I take a step back from that and I talk about what's most important to us. Well, the health of the business, because we don't want to be a loan to own type of lender. So we want a client who's performing and doing the things that they want it to do at the very beginning. And we're actually, our money's actually helping them to achieve those goals for their business. But on the other side, am I worried about my ability to recover on my loan? Has my collateral deteriorated in a way that puts me at risk? That's much different than a tangible net worth covenant where they've breached and we've reset. So for me, collateral is really the focus. So long as my advance rate and the value of that collateral still makes sense, that's a good thing. And now I need to address a problem or a specific challenge in the company that's resulted in a early warning trigger or a covenant breach. And that's often best mitigated by understanding what's going on and dealing with it and resetting that covenant, as opposed to thinking about it from a realization perspective. I think those are two very different ways to measure the health of the portfolio.
Yeah, great. I guess in general, if people are looking for a snapshot of portfolio health, like obviously non-performing loans is one. The loan that we gave a little bit of an interest rate concession on is not a concern whatsoever, just because it's such a low LTV with a diversified collateral base that we just will not lose a dime on that one. Outside of that, is there anything else you're looking at from a lot of the clients out there? There's obviously concern out there with regards to impact of inflation costs. There's been supply chain issues off and on throughout the last 2.5 years. For some of these clients, rising interest rate costs from our cost of our cost to them. There's obviously always going to be some things we're watching as far as real big problems. We've talked about them, but are you seeing much else in the portfolio abnormal, or really just what you would typically see throughout the course of a year?
If it's our portfolio is, for our size, I would suggest pretty darn diversified, which is obviously a good mitigant against changes from an economic perspective. But I think it's important to note that there's always ebbs and flows in a portfolio where you're lending to clients that are using their collateral to support their business. And certainly there's always challenges, whether it's inflationary challenges where they can't pass along those cost increases quickly enough to their clients, where there's a maximum capacity for their clients to accept price increases, which then crunches down on a gross margin, which, when you think about a tangible net worth covenant, doesn't take long if you're crunching down gross margin to trip over a tangible net worth covenant. So long as the business is doing the things that they need to do by being more creative in how they're managing their overhead costs, doing more with less. I mean, who amongst us probably hasn't heard that and had, in your own household probably had that conversation over the last few months, right? There's always going to be those sort of challenges. One transaction that sort of jumps to mind, which is I think a really good example, was a client in the oilfield services business, fairly large accounts receivable facility, also combined with an equally large term loan against machinery and equipment. They had two main verticals in their business, sort of the maintenance type work where they'd go out every day or every couple of days and do project work that lasted a week or so. And then they also had more sort of the larger, more construction-like opportunities. And those projects would last months. And there's a lot more risk in those projects. You need to, your bid needs to be on a razor's edge to meet the competitive aspects of it. You probably don't have a lot built in for supply chain challenges. So materials not arriving on time, and you have guys sitting on a job site costing you money, not adding to something you can actually bill to the customer. And so that client went through, about a year of real challenges. And they came to the decision about the same time we were coming to the conclusion that they needed to make some pretty major changes in what they were doing. And they came to us with a plan. We worked together and structured a change to some of their covenants, which allowed them some time to effectuate the changes in their business. They essentially let go of the entire construction portion of their business, return to sort of the fundamentals, which is time and material. You send a guy out, he turns a wrench, you invoice for it. Not a lot of risk in it. So they had to downsize their crews. They also had to take a lot of the equipment, which was for more of the project and construction aspect of their business, and sell it. So they did a combination of selling equipment on a piece-by-piece basis, through brokers and the like, and also utilizing Ritchie Brothers, in fact, to liquidate via auction. Also, probably about 60% of their fleet of equipment. The good news is they took the time that they needed, which was about 90 to 120 days to effectuate all of the plan. We had benchmarks that they had to hit along the way, which they did. The result of that right sizing was a repayment of our term facility in full. So the collateral performance and the appraisals turned out to be the right numbers. And we just did a renewal for them to extend their revolving facility. It's smaller with some different structure and criteria to it, but that was a way that we could continue to work with a client who made some good decisions, and we were happy to retain the business.
Yeah, great example, Tammy. That kind of concludes the questions I had today. I think we've covered a lot of different area, and I think, with what's going on in the general markets, I think it's important that we had a little bit of a lengthier discussion covering off, a lot of topics here. So, maybe I'll just conclude with the fact that, thanks for joining us today. Hopefully we provided you with some insight and some knowledge as to, how we operate our business, our philosophy towards things, as well as, what we do on a day-to-day basis, a little bit behind the scenes. The fund, has been able to, offer, investors a pretty attractive, risk reward opportunity. We continue to look forward to, deliver those types of opportunities on a go-forward basis, both on absolute return, risk adjusted return, as well as a good portfolio diversifier. And if you have any further questions, feel free to reach out to myself or your regional salespeople. With that, I'm going to start answering some questions. We have 8 in the queue, so I'm not sure we'll get to all 8. But I'll start with a few. Maybe I'll hit on a few of these that I can answer really quickly myself. But, of the $93 million of new originations last year, what percentage came from existing borrowers? So the 93 million actually that we originated last year was just from the US side. There was also Canadian loans and factoring positions that were originated as well. So it amounted to a Canadian dollar equivalent of about $140 million out of a portfolio of about 385 million. Those numbers did not include existing clients that were renewed. So that's one question. As far as percentage of the portfolio that operate on an accrued basis or PIK basis, we kind of covered that. We really don't do them from the outset. In the odd circumstance, we do give some fee or interest rate holidays, but and we kind of gave those examples as well. Tammy, this is something we've talked about recently over the last 2 weeks, but how has the US banking crisis affected credit markets in your business? I guess we talked a little bit about it as well, Erica, but I guess with regards to the deposit side, Tammy, do you want to cover that?
Sure. So I mean, obviously there was the run on the banks, and for a bunch of different reasons. I think the impact to sort of smaller regional banks has been felt particularly over the last couple of weeks. I think I read a statistic that talked about, I think it was $55 billion having left regional and smaller banks in the US, and those deposits have then moved over to the JP Morgan's, Chase, and Bank of America, where people feel more secure. Of course, that impacts the regional bank's ability to lend money, because they're taking retail deposits and turning those into to consumer or commercial loans. So that's, if sitting in the US side, that's a real concern. Those smaller regional banks supported personal car loans right through to, sort of that same SME lending space that we're in. So it'll be interesting to see how that, translates into more opportunities. I think, Erica, you had already seen that uptick of sort of those guys coming out of those smaller regional banks looking for new homes out of maybe concern about renewals and that sort of thing.
100%. Yeah. It remains to be seen, and I expect over the next few months, we'll see the real uptick. We've seen a little bit of it recently. I don't know that it directly relates, but I can make a pretty good connection and assumption. But, as Tammy says, really, when anything happens with the banks, and when banks tighten up and their ability to operate in the same space that we do gets hindered, we tend to get an influx of a lot of opportunities. So again, I'll say it again, luxury of choice. I think that's what we're going to be seeing, and I expect to be seeing over the next 6 to 9 months, I believe. And I think, Tammy, as far as the portfolio or existing portfolio goes, I think you had mentioned you had reached out to our clients to make sure that there was nothing at risk in our portfolio as well, and there was really very minimal impact to any of our clients.
Oh, sure. When Signature and SVB, that news sort of broke, that was our first course of action, was to go out and reach out to all of our clients, and then all of our sort of those lend-to-lender clients that we have, so that we go down to that next level and find out who may have been impacted. Of course, the Fed came back and confirmed that they would support all deposits, which was I think appropriate in the circumstances, although quite a stretch. But frankly, we had, I think, 2 instances where our clients were impacted. In both instances, they pulled cash, like so many other people did. And some of the people we would pay on behalf of our clients had new banking coordinates for wire transfers and the like, as the Fed had taken Treasury over for those particular banks. I had my statistic wrong. I wanted to say 550 billion, but I thought it seemed like such a huge number. But apparently $550 billion has been moved out of smaller and regional banks since that sort of mid-March timeframe. It's an incredibly huge shift that's sort of happened in the last few weeks.
Another question, just a few more, but it just relates to concentration risk of the portfolio. And maybe with it, more so our mindset towards a larger loan. I can kind of prelude this. So, within this portfolio of, say, $380+ million portfolio, we have 55 loans within that portfolio, and about 100 factoring positions, facilities. I'll prelude this and just add to it, maybe the two of you, but typically a larger loan to us, in that 5 to 10% bracket, would tend to err on the side of maybe being a lender finance transaction. Give you an example. Our largest transaction, in the portfolio is a loan to another factoring ABL shop down in the US. Why we get comfortable in, getting that up in size, in the 30s as far as millions of dollars is because the collateral that's backing our loan is over 100 different kind of factoring and asset-based loans within that lender's portfolio. And, we have a high comfort rate in understanding their business because we do it as well. And so for us to lend to someone like that, we're fairly comfortable just because of the diversity of the asset base and our understanding on going a little bit higher. But in general, if you look at some of our larger positions that might be, 15 million and over, or 20, I'd probably say most of them would probably be the lender finance area. I don't know if you have anything to add to what I just said, but
no, that's exactly what I would have said. Those lender finance transactions tend to be higher, and they're way more diverse in the underlying portfolio. Sure, we have one client, but particularly where we're lending to another factoring company, something goes wrong with our client, that all that portfolio can be rolled in and would be considered 100 different clients in our portfolio. So you've got a very well diversified underlying portfolio in that one client. So that concentration is it's a little tricky. It looks, because by virtue of the client being at such a high balance, it really isn't based on that portfolio. I think that's the main event there.
Yeah, perfect. All right. Well, Erica, Tammy, thank you very much for your time today. I think it was very value added to everyone that listened, and thank you everyone that dialed in today. If you have any further questions, just please reach out.
Perfect.
Bye.
Bye.